$2 trillion are about to enter crypto. That's not FOMO, that's me reporting a fact. Morgan Stanley's Global Investment Committee just told its 16,000 financial advisors who manage over $2 trillion in client wealth that cryptocurrency can now be included in diversified portfolios. That single decision marks one of the biggest turning points in modern finance. The same institution that once dismissed Bitcoin as a speculation now calls it digital gold. And that shift unlocks a wall of liquidity Wall Street has kept on the sidelines for more than a decade. And here's the thing, it isn't happening in isolation, in a silo. Bitcoin ETFs are pulling in billions of dollars, and the dollar keeps losing its strength, while gold just hit $4,000 for the first time in history, all while global liquidity is quietly expanding to record levels. So everything we see is pointing in the same direction, that is towards one of the most powerful rotations this market has ever seen and one of the biggest transfers of wealth the world has ever seen. So what's happening right now will decide how capital moves across every corner of the crypto market, from Bitcoin to Ethereum to Solana and Sui, and from there into the next wave of tokenized assets. So stick with me, because by the end of this video, you'll understand why this moment in time could mark the start of a new financial era, and why $2 trillion might just be the ignition to this bull market and this revolution. So let's get started. First off, the ETF data tells the story better than any headline could. On October 6th, Bitcoin ETFs recorded $1.19 billion in net inflows, making the second highest day ever. Meanwhile, Ethereum ETFs added another 176 million yesterday. And since launch, spot Bitcoin ETFs have absorbed or taken in nearly $60 billion in total flows. So this marks the beginning of structural inflows from pension funds, private banks, and family offices, now plugged directly into crypto rails. And BlackRock's iShare Bitcoin Trust is now the most profitable ETF that we see and have. It's generating more annual revenue than any other fund in the firm's portfolio. So this means the world's largest asset manager now makes more money from Bitcoin than it does from gold, bonds, or equities. The capital rotation has already begun, guys. And if we take a look at what's going on with traditional money, fiat as we call it, we see that stocks, gold, and Bitcoin are all hitting new all-time highs right now. And all of them point to one clear driver. That is, the US dollar is losing strength. The dollar has fallen more than 10% year to date, marking its worst annual decline in over 40 years. So confidence in fiat currencies, or traditional currency and money, is breaking down. And with rate cuts now in motion, that decline is accelerating. And if we take a look at the IMF's latest data, it shows the US dollar's share of global reserves has dropped to 56.3%, the lowest level since 1994. So that's down from 85% in the late 1970s. The global monetary system is rebalancing, is what we're seeing, and capital is fleeing, it's searching into stores of value to preserve its value. So if we take a look at the DXY chart, we see the dollar index is testing a 14-year ascending support line around 98. If that level were to break, it would confirm a long-term bear trend for the dollar and a new bull cycle for real assets. Meanwhile, global liquidity has reached record highs, almost $145 trillion, rising steadily since early 2023. So when liquidity expands, as we're seeing right now, and assets inflate, Bitcoin historically reacts first. And gold, we see, just hit $4,000, as I was saying in my intro, for the first time ever. So let's break down why it's performing so strongly and what's driving this move. First, interest rates and real yields are falling, making non-yield assets like gold far more attractive. And central banks are pivoting toward easing, and that's the fuel gold loves and needs. Second, the US dollar is weakening, which boosts global gold demand. And third, central banks are buying it at record pace, adding to reserves month after month. So when gold moves first, it's usually a preview of what's coming for Bitcoin, the harder, more liquid digital version of the same trade. And some analysts keep comparing this moment to the 1999 tech bubble. But that view overlooks how different today's environment really is. Back then, however, the US ran a budget surplus. The Federal Reserve was raising interest rates, and the global trade connections were limited. China hadn't yet joined the World Trade Organization. And today, the world runs on a debt monetization and synchronized liquidity expansion. The Fed's balance sheet is enormous, fiscal debts are the norm, and every round of US stimulus sends liquidity into markets around the world. And right now, what we see is that gold is soaring, the dollar is weakening, and Bitcoin has become the modern outlet for global capital. What we're witnessing is the next phase of the financial system's evolution, a transition towards digital assets that operate on open, borderless networks. And right on cue, that shift is showing up on the charts as capital rotates out of weakening currencies and into hard assets. Bitcoin is already leading the move, kicking off one of the strongest starts in Q4 we've seen in years. And historically, the 41st to 44th weeks of the year rank among Bitcoin's best performing periods, with seasonality pointing to consistent October gains. And on-chain data confirms the trend for us too. Bitcoin whales have started easing their selling after heavy distributions in September, just as retail activity on Binance begins to rise again. So this is the classic Uptober setup. We're seeing early accumulation by smart money, while most of the market still underestimates the move. That's why if you're here watching my video today, you have this upper hand, you have this edge right now, and my hope and wish for you would be that you don't waste it. But instead, take a look at your portfolio, take a look at your income, decide. Go watch my video on Friday, I believe it was, where I explained the barbell strategy, or maybe I'll link it below here for you so you can get a glimpse of how you should distribute your investable, if that's a word, income in the right way that makes sense for you without overexposing yourself and putting yourself at risk of major losses. Because as I heard someone say, you should go into these investments happy to lose whatever you lose. I know that may sound crazy, but that's how you have to see it, because you cannot cry over any money you lose, but there very much so is a formula, and just about every single token and crypto project I cover on my channel will be good ones, and I'll always explain pros and cons to you. So you should be fairly safe, though it's not financial advice. Anyway, now let's shift gears and talk about the altcoin market and what may very well kick it off. Right now, the total crypto market cap, excluding Bitcoin and Ethereum, known as the total three, has officially broken out, forming a massive bullish structure that could target $1.6 trillion. And here's the nuance most traders miss, and that is the total three includes stablecoins, meaning the breakout partly reflects inflows from capital being parked in stables before deployment. So the real trigger is total three, which removes stablecoins from circulation. That's the chart that shows when true altcoin season begins. And right now we see market momentum is building, and the next phase begins when that rotation moves out of stables and into high beta assets. So within that context, Solana is taking the spotlight. Since the Genius Act passed, its stablecoin supply has surged 40% to 15 billion, which is the fastest growth of any chain. Solana's dApps also generated 140 million in revenue last month, outperforming all layer 1 and layer 2 ecosystems combined. And at the same time, Sui became the first blockchain with quantum-ready account infrastructure, debuting at one of the world's top security conferences. Sui's stablecoin market cap also flipped Ton, Mantle, and Optimism, confirming that new layer ones are attracting real capital flow. So if we watch the large caps closely, they're next in line to move once Bitcoin and Ethereum finish leading the charge, leading the way. And if we shift the conversation and our focus towards tokenization, which we know is the future, as capital starts rotating across the major layer ones, another wave is forming beneath the surface. The institutional push to bring real world assets on chain, as I was saying, tokenization. The next phase goes beyond market rotations and layer one growth. It goes beyond speculation, basically. And instead, traditional finance begins moving onto blockchain rails. Real world use case application for blockchain and crypto technology as it was designed to be used. And right now, we see ARK Invest just made a $10 million move into Securitize, a firm already partnered with BlackRock, Hamilton Lane, and Apollo, making it ARK's 8th largest position after OpenAI, Neuralink, and SpaceX. So this marks where the next trillion is heading. That is tokenized real-world assets and 24 hours, 7 days a week markets. And the NYSE's parent company, Intercontinental Exchange, known as ICE, is also in talks to invest $2 billion in Polymarket, valuing the predictions platform near $10 billion. Polymarket also added Bitcoin deposits, allowing traders to fund accounts directly with Bitcoin. And in Asia, South Korea is launching a won-backed stablecoin on Avalanche later this year, with tokenized assets set to follow in early 2026. Meanwhile, on Ethereum, corporate treasuries and ETFs now hold more than 10% of the total ETH supply, roughly 12.5 million on ETH. These developments aren't side stories. They're clear signs that the on-chain financial system is being built in real time and at the scale and conviction level required in letting us know that this is a trajectory the world in general is moving into. So, as we wrap up today's video, in summary, what we see is every data point we've covered points to one clear conclusion. Liquidity is expanding, fiat confidence is eroding, and institutions are embedding themselves deeper into crypto infrastructure. Bitcoin's ETF inflows, Ethereum's treasuries, and Solana's dApp boom, as well as gold's surge, all tell the same story. We're living through a global migration of capital. It's a rotation from paper to protocol, from managed wealth to programmable assets. This is the moment Wall Street stopped fighting crypto and started joining it. And hopefully you do too. So stay early, stay informed, stay plugged in. I'll be back here tomorrow again. Re-examine all your positions. Let me know what you're holding or any questions you have. I do read all your comments and I take them into consideration for future videos. I love you guys so much and I'll catch you guys here tomorrow. Ciao.